You know that feeling when you finally decide to buy something and then the price immediately drops? Like you buy a new phone and the next day it goes on sale for $200 less? Now imagine that feeling, but it's with your entire investment portfolio. You bought Bitcoin at $104,000 in November 2024. You believed in it. You did your research. The institutions were finally coming in. BlackRock had their ETF. Microstrategy was buying billions. And now you're watching it bounce between $85,000 and $98,000. And you keep asking yourself the same question everyone asks. We hit all-time highs. The ETFs are here. Institutional adoption is real. So why isn't this thing at $150,000 or $200,000 yet? What am I missing? Look, my name is Tom, and I spend way too much time thinking about why assets don't behave the way they're supposed to. If you're someone who bought Bitcoin anywhere between $95,000 and $108,000 over the last few months, believes in the technology, understands the scarcity argument, but can't figure out why the price action makes absolutely no sense compared to institutional adoption, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. Here's the thing. I wasn't planning on making this video. The whole banks are manipulating Bitcoin narrative felt like conspiracy theory territory. The kind of thing people post on Twitter at 2 in the morning with zero evidence. But then I started digging into the actual mechanics of how modern financial institutions can legally suppress asset prices. And what I found genuinely shocked me. We're not talking about some shadowy backroom deal. We're talking about financial structures that have been used to destroy companies worth billions of dollars. Structures that are perfectly legal. Structures that have historical precedent going back over 100 years. And here's what most people don't realize. The exact same playbook that was used to collapse hundreds of companies in the early 2000s, the exact same playbook that empires use to control entire nations through debt, is potentially being deployed right now against the largest Bitcoin holders in the world. And if you own Bitcoin, you need to understand this. So let me start with a story that's going to sound completely unrelated, but I promise it'll all connect. Back in 1982, Mexico did something that seemed smart at the time. They borrowed billions of dollars from international banks to fund infrastructure projects, economic growth, the future, except here's the problem. That debt was denominated in US dollars, not Mexican pesos, US dollars. Now, why does that matter? Because Mexico doesn't control US dollars. They can't print more of them. They can only earn them through exports or borrow more. So in 1982, when the US Federal Reserve jacked up interest rates to fight inflation, suddenly Mexico's debt payments exploded. The dollar got stronger, the peso got weaker. And Mexico found itself in this impossible situation where they owed $80 billion and had no way to pay it back. So what happened? The IMF, the International Monetary Fund, stepped in with what they called a rescue package. But here's what that rescue package actually meant. Mexico had to agree to something called structural adjustment. They had to privatize state-owned companies. They had to cut social spending. They had to open their markets to foreign investors. Basically, they had to sell pieces of their country to pay back the banks. And this wasn't unique to Mexico. This exact pattern played out in Argentina, in Brazil, in Indonesia, in dozens of countries over the next few decades. Now you might be thinking, Tom, what does this have to do with Bitcoin? Everything. Because what I just described is called a debt spiral. And the reason it's so devastating is because of the psychology behind it. See, when you owe debt in a currency you can't control, you're not just at risk of economic pressure. You're at risk of losing sovereignty, of losing control of your own assets. And here's where it gets really interesting. This same mechanism, this debt spiral, doesn't just apply to countries, it applies to companies. And right now, there's a company that holds over $60 billion worth of Bitcoin. And they're structured in a way that makes them potentially vulnerable to the exact same trap. Let me give you a different example, something closer to home. Imagine you own a house worth $500,000. You take out a home equity line of credit for $100,000 at a variable interest rate. Right now, rates are low, so you're paying maybe $400 a month. No big deal. You can afford that, but then the Fed raises rates. Suddenly you're paying $900 a month, then $1,000, $200, and your income hasn't changed. So what do? Well, if you can't afford the payments, you have three options. 1, you sell the house. 2, you refinance, which means taking on more debt. Or 3, you default and the bank takes your house. Now, here's the psychological trap. The moment you start worrying about making your payments, you start making desperate decisions. You might sell the house at a loss just to avoid default. You might refinance at terrible terms just to buy time. And the entire time, the bank that lent you that money is sitting there knowing you're stuck. This is what I call financial pressure without financial crime. The bank didn't do anything illegal. They just created a structure where your interests and their interests are fundamentally misaligned. And when the environment changes, rates go up, markets go down, suddenly you're trapped. Now scale that up. Instead of a house, imagine it's $60 billion worth of Bitcoin. Instead of a home equity line, imagine it's $16 billion worth of convertible bonds and preferred shares. And instead of some random homeowner, imagine it's a publicly traded company whose stock price directly impacts whether they can keep their Bitcoin or have to sell it. That company exists. It's called Microstrategy. And understanding what's happening with Microstrategy is the key to understanding why Bitcoin might be getting artificially suppressed right now. So let's talk about what Microstrategy actually is. On paper, they're a software company. They sell business intelligence software, but that's not really what they are anymore. What they've become is essentially a leveraged Bitcoin fund disguised as a corporation. And the way they've structured this is both brilliant and potentially catastrophic. Here's how it works. MicroStrategy raises money in 3 ways. 1, they sell shares of their stock. 2, they issue convertible bonds. And 3, they issue preferred shares. And then they take all that money and they buy Bitcoin. As of right now, they own about 450,000 Bitcoin. At today's prices, that's worth roughly $45 billion. They paid about $27 billion for it. So they're sitting on an unrealized gain of $18 billion. Now that sounds amazing, right? But here's the catch. Those convertible bonds and preferred shares come with obligations. The convertible bonds have interest payments. The preferred shares have dividend payments. And unlike regular stock dividends that a company can just stop paying, preferred dividends are mandatory. If you don't pay them, you default. So right now, MicroStrategy owes about $700 million a year just to service their debt and dividends. That's almost $2 million every single day. Now, where does that money come from? Their software business generates maybe $100 million in free cash flow. That's not enough. So they've built up a cash reserve of about $1,200 million specifically to pay these obligations. At current burn rates, that cash reserve will last about 20 months, less than 2 years. And this is where the debt spiral becomes a real possibility. Let me explain the trap they're in. MicroStrategy's stock currently trades at what's called a premium to net asset value. What that means is if you look at the value of all their Bitcoin and subtract all their debt, you get a number. Let's call it $30 billion. But the market values the company at $50 billion. So there's a $20 billion premium. Why? Because investors believe MicroStrategy will keep buying more Bitcoin, and that Bitcoin will go up in value. As long as the stock trades at a premium, MicroStrategy can keep selling shares to raise cash. They sell $1 billion worth of stock. They use that money to buy more Bitcoin. The Bitcoin goes up. The stock goes up. They sell more stock. They buy more Bitcoin. It's a flywheel. It works beautifully. But here's the problem. What happens if the stock stops trading at a premium? What happens if the market decides, you know what? We're not going to pay $50 billion for a company whose assets are only worth $30 billion. What happens when the stock trades at a discount? Well, suddenly MicroStrategy can't sell shares anymore. Because if the stock is worth less than the Bitcoin they own, selling shares would be like selling Bitcoin at a loss. So they stop issuing equity. And now that $1,200,000,000 cash reserve is the only thing standing between them and having to sell Bitcoin to pay their obligations. 20 months, that's it. And if they start selling Bitcoin to pay their debts, what happens to the Bitcoin price? It goes down. And if the Bitcoin price goes down, what happens to MicroStrategy stock? It goes down further. And if the stock goes down further, they have to sell even more Bitcoin. This is the death spiral. Now, you might be thinking, okay, Tom, but why would anyone want this to happen? Why would banks or institutions try to push MicroStrategy into this situation? Here's where the psychology gets dark. Imagine you're a major investment bank. You have clients who want exposure to Bitcoin, but they're institutional clients, pension funds, endowments, sovereign wealth funds. These aren't crypto bros buying on Coinbase. These are serious financial institutions with strict rules about what they can invest in. Now, these institutions can't just buy Bitcoin directly. It's too volatile, there's regulatory concerns, there's custody issues. But what if there was a way for them to buy Bitcoin at a massive discount? What if instead of paying $95,000 per Bitcoin, they could effectively buy it for $70,000 or $75,000? Here's how that could work. If MicroStrategy gets pushed into a position where they have to sell Bitcoin, they're not going to sell it on the open market. They're going to do what's called a block trade. They're going to call up a few major investment banks and say, hey, we need to sell $5 billion worth of Bitcoin. Who wants it? And those banks are going to say, sure, we'll take it, but we want a discount because we're taking on that much risk. So suddenly, these banks can buy billions of dollars worth of Bitcoin at 10%, 15%, 20% below market price. And then they turn around and sell it to their institutional clients at a markup, or they hold it themselves. Either way, they've just acquired a massive amount of Bitcoin at a discount. But here's the thing. For this to work, they need MicroStrategy to actually be in distress. They need the stock to trade below net asset value. They need that cash reserve to run low. They need the pressure to build. And how do you create that pressure? You short the stock. Now, let me be very clear here. I don't have evidence of a coordinated conspiracy. I don't have recordings of bankers in a smoky room planning this out. But I do have history. And history shows us that this exact playbook has been used before. In the early 2000s, there was a financing structure called pipe deals, private investment in public equity, and a specific type of pipe deal called a floorless convertible. Here's how it worked. A company that was struggling to raise money would go to a hedge fund and say, we need cash. Will you lend it to us? And the hedge fund would say, sure, we'll lend you $10 million, but instead of paying us back in cash, you pay us back in stock. And the lower your stock price goes, the more shares we get. Now, think about that for a second. The lower the stock price, the more shares the lender gets. What's the financial incentive there? To push the stock price down. And how do you push a stock price down? You short it. You spread negative rumors. You create fear. The SEC investigated hundreds of these deals in the early 2000s, and what they found was devastating. Companies that entered into these agreements saw their stock prices fall an average of 34% within 1 year. About 85% of the companies had negative returns, and 48% of them were completely delisted, wiped out, gone. This wasn't theory. This actually happened. Real companies, real shareholders who lost everything, and it was perfectly legal. Now, MicroStrategy doesn't have floorless convertibles. Their debt structure is different, but the psychological dynamic is similar. If you're a hedge fund or a bank and you believe that MicroStrategy is going to eventually be forced to sell Bitcoin, what's your move? You short the stock, you apply pressure, you wait. Let me give you some numbers to show you how real this is. In February 2025, MicroStrategy stock fell to a point where the entire company was valued at $10 billion less than the Bitcoin they owned. Think about that. You could buy shares of MicroStrategy and effectively get Bitcoin at an 18% discount compared to just buying Bitcoin directly. Why would the market do that? Because the market was pricing in the risk of the death spiral. The market was saying, yeah, you own all this Bitcoin, but you're also sitting on $16 billion of debt. And if anything goes wrong, you're going to have to start selling that Bitcoin. And when you do, we're all going to lose money. Now, during that same time period, we saw massive short interest in MicroStrategy, billions of dollars of short positions. Who was shorting? We don't know all the names, but we do know that some hedge funds publicly announced their shorts. Jim Chanos, a famous short seller, openly said he was betting against MicroStrategy. And we also know that JP Morgan published multiple research reports saying that MicroStrategy was overvalued, that the structure was risky, that if the stock fell far enough, it could get kicked out of major indexes, which would force index funds to sell, which would push the price down even more. Now, is that market manipulation? Legally? No. Publishing research is protected speech. Shorting stocks is a normal part of markets, but the net effect is the same. You're creating pressure on a company that's structurally vulnerable to pressure. Here's what most people don't realize about how modern financial warfare works. You don't need to do anything illegal. You just need to understand the incentive structures and exploit them. It's like playing poker. You don't need to cheat. You just need to know when someone's bluffing and apply pressure at the right time. Think about it from a psychological perspective. If you're Michael Saylor, the CEO of MicroStrategy, and you're watching your stock get shorted into the ground, what are your options? You can keep buying more Bitcoin and hope the price recovers. You can try to raise more money by selling shares, but that dilutes existing shareholders. You can try to pay down debt, but that requires selling Bitcoin, which is exactly what you don't want to do. You're stuck. And the people shorting your stock know you're stuck. They're not hoping you fail. They're betting on a specific outcome. They're betting that eventually the pressure becomes too much and you're forced to sell Bitcoin at exactly the wrong time, which confirms their thesis and makes them money. This is the dark part. This isn't about Bitcoin failing. This isn't about the technology being flawed. This is about financial structures being weaponized against the largest Bitcoin holders to force them to sell at a discount. Now, let me address the obvious question. If this is true, what can you do about it? Because I know some of you are thinking, great, Tom, now I'm terrified. Should I sell my Bitcoin? No. Here's why. The people who understand this dynamic are the ones who win. Let me explain. First, understand that MicroStrategy is not Bitcoin. Bitcoin is a decentralized asset. MicroStrategy is a company with a complex capital structure. If MicroStrategy gets into trouble, that doesn't mean Bitcoin is flawed. It means a specific company made specific financial decisions that created specific risks. Second, recognize that this pressure creates opportunity. If banks and institutions are trying to acquire Bitcoin at a discount by forcing distressed sellers, what does that tell you? It tells you they want Bitcoin. They believe in the long-term value. They're just trying to get it cheap. So if you're a long-term holder, the absolute worst thing you can do is panic sell during moments of manufactured pressure, because that's exactly what the institutions want. They want you to sell your Bitcoin to them at $85,000 so they can hold it and sell it to their clients at $150,000 in 2 years. Third, pay attention to the time frames. Remember, MicroStrategy has about 20 months of cash reserves. That means even in the worst case scenario, there's a countdown clock. And markets hate countdown clocks. The closer we get to that deadline, the more volatility you're going to see. But if Bitcoin's price recovers before then, if MicroStrategy can raise more capital, if they can refinance their debt on better terms, the whole death spiral thesis falls apart. Let me give you a specific example of how to think about this. Let's say you bought Bitcoin at $100,000 in November 2024. You put in $10,000. So you own 0.1 Bitcoin. Now you're watching all this MicroStrategy drama unfold. Bitcoin is trading around $92,000 and you're worried. Should you sell? Here's the math. If you sell now at $92,000, you've lost $800. That hurts. But let's say this whole theory is true. Let's say banks are suppressing the price. Let's say MicroStrategy gets forced to sell some Bitcoin and the price drops to $78,000. You panic and sell at a bigger loss. you lose $2,200. But now imagine you held. You understood the game. You knew that institutional players were trying to accumulate at lower prices. So when the price dropped to $78,000, you bought more. You put in another $7,800 and got yourself to 0.2 Bitcoin total. Now, 6 months later, the pressure resolves. Microstrategy refinances. The short sellers close their positions. Bitcoin goes to $140,000. Your 0.2 Bitcoin is worth $28,000. You put in $17,800 total. You made $10,200. The psychology here is everything. The people who win in markets aren't the ones with perfect information. They're the ones who can manage their emotions and stick to a strategy when everyone else is panicking. Now, this is where I have to explain something about how professional investors think differently than retail investors. When a retail investor sees Bitcoin drop from $105,000 to $88,000, they think, oh no, I'm losing money. I should sell. When a professional investor sees that same drop, they ask a different question. They ask, why is this happening? And is the fundamental thesis still valid? See, professional investors don't just react to price movements. They try to understand the mechanics behind the price movements. And if they determine that the price is being artificially suppressed through financial engineering rather than fundamental problems with the asset, they do the opposite of what retail investors do. They buy more. This is how wealth transfers happen. This is how institutions accumulate assets from retail investors. Not through scams, not through fraud, through psychological pressure applied at scale. And Bitcoin is the perfect asset for this kind of play because it's so volatile already. If Bitcoin drops 20%, retail investors panic. But institutions look at the on-chain data, they look at the adoption metrics, they look at the long-term trends, and they say, this drop is noise. This is a buying opportunity. Let me tell you a quick story about something similar that happened in the gold market. Back in the 1990 seconds, central banks around the world were selling their gold reserves. The Bank of England famously sold half of Britain's gold reserves at an average price of $275 per ounce. The market called it the brown bottom, after Gordon Brown, the chancellor who authorized the sales. Now, why would they sell? The official reason was that gold was a barbarous relic, that it didn't generate yield, that it was better to hold dollars or bonds. But here's what happened next. Over the next 20 years, gold went from $275 to over $1,900 per ounce. The Bank of England lost billions of pounds in potential gains. Now, here's the conspiracy theory version. Some people believe those central banks weren't stupid. They were coordinating with private banks who wanted to buy gold cheap. The central bank sold, the price crashed, private institutions accumulated, and then the price went back up. Can I prove that? No. But the pattern is there. Institutional sellers create selling pressure. Prices drop, smart money accumulates, prices recover. And the original sellers look foolish, while the accumulators make fortunes. Is the same thing happening with Bitcoin right now? I don't know. But the incentive structure is there. The mechanism is there. And the historical precedent is there. So let me give you the action steps. Here's what you should actually do with this information. 1. If you own Bitcoin, do not panic sell based on short-term price movements. Understand that volatility is part of the game. The question isn't whether Bitcoin will drop 20% or 30%. The question is whether the long-term fundamentals have changed. And in my view, they haven't. 2, pay attention to Microstrategy's quarterly reports. They publish detailed information about their cash reserves, their debt obligations, and their Bitcoin holdings. If you see that cash reserve starting to run low, if you see them actually having to sell Bitcoin, that's a real signal. But until then, it's just speculation. 3, diversify your crypto holdings. Don't put everything in Bitcoin. Don't put everything in any single asset. Spread your risk. If institutions are playing games with Bitcoin's price, they might be playing similar games with other assets. 4, and this is the most important one, educate yourself on how financial markets actually work. Because the people who understand debt spirals, convertible bonds, short selling, net asset value, These people have an enormous advantage over people who just look at price charts and hope for the best. Here's what I want you to understand. The reason I spent 45 minutes explaining debt spirals in the Ottoman Empire, pipe deals in the 2000s, and MicroStrategy's capital structure today is because these things are all connected. Financial engineering is a tool. It can be used to build wealth, or it can be used to extract wealth. And the scary part is, most people don't even realize it's happening. They just see their portfolio going down and think, I guess I was wrong about Bitcoin. But you weren't wrong. You were outmaneuvered by people who understand the game better than you. Look, I'm not here to tell you Bitcoin is going to $500,000 next year. I'm not here to promise you anything. What I'm here to do is show you the mechanics of how large institutions can apply pressure to an asset through completely legal means, and how understanding those mechanics can make you a better investor. Because at the end of the day, investing isn't about being right. It's about understanding risk, managing your emotions, and having the patience to let long-term fundamentals play out while everyone else is freaking out about short-term noise. So, what's gonna happen with Bitcoin? I don't know. What I do know is this. If institutions are trying to accumulate Bitcoin at lower prices, that tells me they believe in the long-term value. If they didn't, they wouldn't bother with these complex financial structures. They'd just ignore it. The fact that there's all this pressure, all this drama, all these games being played, that actually makes me more confident in Bitcoin, not less. Because you don't engineer complex short attacks against assets you think are worthless. You ignore worthless assets. You engineer attacks against assets you want to own but don't want to pay full price for. So if you're feeling scared right now, if you're worried about your Bitcoin holdings, I want you to ask yourself one question. Do you believe in the long-term thesis? Do you believe that a scarce, decentralized digital asset has value in a world where governments are printing trillions of dollars? If you do, then short-term price manipulation shouldn't change your strategy. It should be an opportunity. And if you don't believe in that thesis, if you think Bitcoin is just a speculative bubble, then honestly, you probably shouldn't own it in the first place. Because this volatility, this manipulation, this drama, it's not going away. This is the game. And the only way to win is to understand the rules better than the people trying to take your money. So hit that subscribe button if this video helped you understand what's really going on. Drop a comment and let me know if you think this death spiral is real or if I'm just connecting dots that don't exist. And most importantly, keep learning. Keep asking questions. Keep digging into how this stuff actually works. Because at the end of the day, the best defense against financial manipulation is education. Know what you own, know why you own it, and know when someone's trying to play games with you. I'll see you in the next video.